Back to business, a swift 1-2 punch, if you will. Standard Chartered Bank beating the street and impressing many, posting close to $2 billion in interim 6-month profits, and then in the same breath raising $1.75 billion in a stock sale to shore up its coffers, build up their Tier 1 and Tier whatever capital base, and potentially fund expansion in Asia. Just 9 months after the bank raised over $3 billion in a rights offer. The bank is in talks with RBS, of course, to buy its assets in China, India, and Malaysia, those that weren't picked up by ANZ Bank. And, of course, we brought you the news first here with the CEO, Michael Smith, right on this show, Asia Confidential, yesterday. Our guest today from Singapore is Viz Shankar, member of the Group Management Committee at Standard Chartered Bank, also serves as Executive Chairman of Principal Finance and Chairman of the Standard Chartered Private Bank. Mr. Shankar, welcome to the program. A very impressive set of results, an impressive cash call that seemed to wow the markets. One of the big bank chiefs, Mr. Stephen Green from HSBC yesterday told me we are well past the worst of it. I think it's quite clear from Standard Chartered's experience, yes?
Yes, absolutely, Bernie. Good morning. We are very happy with the results, and I think we achieved it despite the turbulence and turmoil in the markets. We are doubly pleased because of that. And it's important to look at how we got there. It's by staying open for business, remaining very client-centric, sticking to our core strategy of focusing on Asia, Africa, and the Middle East, and sticking to the basics of banking. Focus on liquidity, capital, risk, operational risk, and customer service. So we are very pleased.
What are the caveats? What are the cautionary lessons in this earnings report, Mr. Shankar? We just saw a little graphic there showing the leaps and bounds and the improvements that we saw in wholesale banking, but consumer banking, and it's not particular to Standard Chart. I mean, every bank is having the same problem. Consumer banking could use a little bit of a lift. What can the bank do about this?
Yeah, at any point of time, depending on the economic cycle, the wholesale bank engine will run faster or slower, or the consumer bank engine could run faster or slower. Clearly, in the last few years, the wholesale bank engine has been revving up faster because of the macroeconomic conditions. But I think we are going through a transformational journey in our consumer bank, and we are making it far more customer-centric. And I think given the right wins, consumer bank will begin to fire.
Shankar, in relationship to the consumer banking side, given now that the overwhelming majority of Asian central banks are now sitting on their hands on interest rates, in other words, they cut, and they have come to a stop. Now, clearly, I mean, it doesn't take a genius, and most definitely it doesn't take me, because I'm not a genius, okay, to expect that the next move very likely is going to be up. Now, is this something of a concern collectively? Because after all, I am also a banker, and this is something that taxes my mind. So I would like you to share your thoughts in terms of, is this going to be something of a concern when the next stage, of course, is going to be for Asian interest rates to go up, irrespective of what the Americans are doing, because that's exactly what has been happening. Any thoughts on this at all?
Andrew, if you're talking specifically to consumer banking, actually an increase in interest rates should help it, because particularly if you're a liability generation engine, which we are, then an increase in interest rates helps the income from liabilities and also drives up the wealth management income. So actually it's quite helpful. From the limited standpoint of consumer banking income, an increase in interest rates should help. But to answer the question differently on a more macro basis, under what conditions would central banks be raising interest in Asia? It would be under a scenario where the economies are beginning to experience higher growth, which means higher consumer spending, which means higher spending by all participants, whether it's the governments, the households, or the corporates, which should be actually very good for our economies. So actually, I see that as a positive.
That's definitely a very, very interesting take, in the sense that, as you're saying, we are bankers, so we like higher interest rates because we charge more. But as you say rightly, in the context of the macroeconomic side, That's an altogether different stage. Because, of course, my key concern is whether the first one, to begin to increase interest rates, or at least to conscientiously tighten monetary policy, is likely to be the People's Bank of China, given, of course, both the spectacular performance of the stock market in China and, of course, a very strong performance of the Chinese economy. I'm not quite sure whether it's a statement or a question, but you can take it as a question. Okay.
Okay, I will take it as a question, Andrew, for old time's sake.
They're friends. We're so civil here.
So what I would say is that clearly, the focus of the central banks and the monetary authorities over the last year has been how to avoid a recession or how to soft land the respective economies. And one has to agree that they have done a very good job of that. So you're seeing many of the economies slowing down, but slowing down much faster than would have been the case if they hadn't put in place the stimulus packages. Now, a year and a half down the road, and we believe this recession is going to be very short and shallow in Asia, and Asia will emerge out of this quicker. Also because Asian economies and companies went into this recession in much better shape than many of their Western counterparts. So they will emerge faster, and that could lead to an increase in interest rates.
Shankar, it's great to talk to you, okay? Next time we'll have to have the beer between the three of us. V. Shankar joining us.
Absolutely.
Good to see you,
from Singapore.